number one problem is that there's holes in your bank account, and the holes are draining you. You have to know where all your money is going. And most millionaires do. Actually, if you statistically surveyed millionaires, they know almost to the dollar where all their money's going every month. That's why they're millionaires, because they know they control their expenses. That's the number one budgeting tip that I learned, and that's what I share with my clients, is we need to patch the holes as soon as possible.
Welcome to another episode of the Business 101 podcast. I am your host, Ayo. And today we're talking about the lifeblood of every business and a part of our everyday life that people tend to take for granted, money. You say this podcast is essentially about helping people be better business people and teaching them the strategies that have made other businesses work or fail. And if people don't get on top of their money game, they essentially cannot invest in the businesses that they care about or live the lifestyle that they want. And so today I have with me Paris Cluff, who is a financial advisor, coach, entrepreneur, and educator. Paris has about 20 years experience helping people turn their income into real lasting wealth. He's here to teach systems and strategies that help people get on top of their money game so that they can invest in and build the businesses that they care about. Whether you're an early stage founder figuring out your cash flow or a working professional trying to get a grip on your finances, this is the episode you didn't know you needed. So let's get started. Welcome to the show, Paris. Good to have you here.
Well, thank you. I appreciate it. I'm excited to be here and share a few things about some things I'm passionate about. So thank you for inviting me and having me on.
Amazing, absolutely. It's good to have you here as well. Looking forward to where the conversation goes. But starting off right, let's talk a bit about your journey. How did you get here? So when I introduced you, I mentioned that you are a financial advisor, you are a coach, an entrepreneur, and an educator. Let's talk through all four of those and see what the trend is.
Yeah, so I actually have been entrepreneurial my whole life. I was the kid that walked around the neighborhood, knocking on doors, selling greeting cards, and I had the lemonade stand, every weekend in the summers. And so
Yeah.
I was always looking for ways to make money and be entrepreneurial. I'm sure many of your listeners can relate to that.
Yeah.
I actually was working in corporate America, and because that's you know how it goes off and on. There's an old saying that most entrepreneurs probably start and fail 6 or 7 businesses before they
Yeah.
find the one that actually fits. And that was certainly my story a little bit. I was working in corporate America. I had just qualified for the 401k at work. At the time, all I knew about money was that it was green and I wanted more of it. And I barely knew how to spell 401k. So when the HR department came to me and said, "Hey, Paris, you qualified for the 401k," I'm like, "What in the world is that?" I
Uh,
asked a few of I asked a few of my coworkers and said, "What did you do? What are you doing?" And flip a coin, throw darts, put it all in the company stock were some of the answers. And I thought, I better figure this out, because to me, retirement was like as important as what house do I buy? Who do I marry? Oh, how many kids am I
yeah.
going to have? Like, it's a pretty important thing. And it's, the old adage is that you got to start retirement early. So I wanted to do it right. And so I started reading a bunch of books. Finally got to the point where I was comfortable doing my own investment. And a coworker turns to me and says, "Paris, I see you reading all these books. I just qualified for the 401k too. Would you help me?" And I was kind of shocked a little bit, because she was older and I figured she'd figured all this out way before I did. So I just said, "Look, I'm not a professional." At that time I wasn't. And I can just share with you what I've been reading. And so I shared with her some of the things that I read. And she says, "Paris, you have a gift. I finally understand how to do 401k. I actually have never been able to understand this. You've been able to share this with me. You should do this for a living." And I was like, wow, well, maybe I should. So I started to look for opportunities. I had a couple of friends that were CPAs and CFPs and lawyers. And I said, yeah, if you were to do it again, what would you do differently? And I started interviewing some of my people that I knew, my associates that I had that were professionals in those areas. And while I was doing that, I was actually planning to go to I had just got my associate's degree, and I was planning to transfer to the university in California at Fresno, actually Fresno State University. And they told me I had to, because I was a transfer student, I had to delay a couple months. And in that time frame, a guy came to me and said, "Hey, Paris," a recruiter for a financial services firm came to me and says, "Paris, you can come work with us and you can earn while you learn, or you can go to school and you can learn and then earn." And I was like, well, I'm starting a new family. I just brand new to the world. I'd rather earn while I learn. And so I actually I did it at the time. It was just, I just worked in my off hours. I worked when I wasn't at my full-time job, I worked building my financial services industry business. But today it would be called a side hustle. So apparently I was an early adopter of side hustles, and I worked for about 3 years doing that while I worked at my full-time job. A lot of times when people go have an entrepreneurial spirit to them, they have a job and they have this idea, and there's a lot that goes into actually being ready to launch. And I was scared to launch. I mean, just to be honest, I was scared. That's probably why it took 3 years. I was scared to launch. I had a child, I had a wife, I had people responsibilities, and I was scared to cut ties with my work, my guaranteed income, to go pursue something that was who knows. And I had some savings, and so I felt like I was good to go, and I stepped off the cliff, so to speak, and flew. And so I've never looked back. I actually, it was kind of funny. I had one of my coworkers before I left. I was telling everybody goodbye. She says, "Look, I know you have kids. If they're ever hungry, just call me." And I was like, "You clearly don't have any faith that I'm going to make this
Yeah,
business work." That was 21 years ago, and I've been self-employed ever since.
interesting, interesting. And as part of your business, you coach people. What does financial coaching look like?
So there's a lot of differentiation that can be made. A lot of people think they need a financial advisor, and that's probably true at some point. I was a financial advisor from 2001 to 2015, and this is how I define a financial advisor. Financial advisors usually have some kind of product or service that are trying to sell you in order to be compensated on a commission or something like that. So, as a financial advisor, often that would be a stock, a mutual fund, an ETF. Some financial advisors, are life insurance agents as well, so they'll sell life insurance products. And so there's an advisor. If you look up the definition on Google, a financial advisor is somebody who's trying to sell you something on a commission basis, usually. Now there's some nuance too, because financial advisors can be financial planners, and financial planners can be financial advisors. But financial planners, what they'll do is kind of differentiate is they'll sit down with you and they'll look at your goals, they'll look at where you are now, and they'll create a plan that will help you get from where you are to where you want to be. And then they'll make a fancy chart. Here's an example. I have a friend who I met, and he went to a financial planner, and they sat down with him and his wife and his family, and they did this whole plan. And he paid several $100s for it, and they handed him the notebook, and it was nice leather bound with all the charts and graphs. And, if you put this much money away, you'll be this rich in this many years and all these things. And then they said, basically, good luck. Thanks for coming in. And he took the book, he took the folder and walked out of there not knowing what to actually do. And so and here comes enter the financial coach. Financial coach is actually more of a life coach, but we focus in on helping people with their money because not honestly, money touches everything. The number one cause of stress in the world is money problems. The number one cause of divorce in the world is well, I don't know if it's the number one, but it's a leading cause of divorce in the world is money problems. So and the leading cause of disease is stress. So in my opinion, money touches everything. It touches your health, it touches your relationships, it touches all kinds of things. And so as a coach, I have the knowledge of a financial advisor, I have the knowledge of a financial planner, but then as a coach, what I'm going to do is I'm going to step in and I'm going to help you figure out. So for an example, I will help you get out of debt more quickly than you've ever gotten out of debt in any other way. However, I'm also going to talk to you about why did you get in debt in the first place? We're going to change the habits and beliefs that you have around that. The other thing is that as a financial coach, I'm not beholden to sell you a certain mutual fund or IRA or certain stock or something like that. So I can sit down with you and say, okay, what do you want to do? Do you want to build a business? Do you want to start real estate? Do you want to get into the stock market? I can give you the questions to ask so that when you walk in to talk to a financial advisor, you go in equipped and ready to go. So financial coaches really deal with a lot more about behaviors, beliefs, and habits than they do with the actual nuts and bolts of investing and things of that nature. So that's kind of how I define each one of those. And so I think that most people should start with a coach, and then a good coach is going to have resources to financial advisors and planners that may be able to give them more,
That
if that
makes
makes sense.
that makes all the sense. And you kind of bifurcate between an educator and a coach. Is there a difference, or yeah, are those just word plays?
So there is a difference because a coach, so an educator will just basically, for example, if you went to school, an educator stands in front of the classroom and just dumps a bunch of knowledge on you. Basically tells you to go do your homework and come back and hopefully you pass the test. So a coach is going to be more like, okay, I'm going to
Involved.
a good coach is going to educate you on different strategies, tax strategies, investment strategies, debt strategies, saving strategies, income strategies,
Yeah.
spending strategies. Like one of the things when I first sit down with somebody, I sit down and say, okay, what are your goals financially? Everybody says, I want to be financially free. A common definition of financial free is the ability to do whatever you want, whenever you want, with whomever
Yeah.
you want.
Yeah.
But then they never actually sit down and say, well, who would I do that with? And when would I do it? And how would I do it? Like they say, yeah, I want to be financially free, but then they never really define it. And so I sit down, my first initial meeting is what I call a game planning session. And if you think of the first letters of each of those, it's a GPS. And so everybody's opened their phone to get to a destination and they've used GPS. And so if you just typed into your phone, take me to my friend's house, the phone is like, which friend? Like, that's not, you need to tell me exactly an address.
Yeah.
And so that's what I do as a coach. I'll sit down and as an educator, I can teach you how to do it. And as a coach, I'll do it with you. I'll work with you and I'll help you figure it out. And so you have that destination. Well, the next thing you need to know on your GPS is where are you? What's your current location? So if you want to figure out where you're going, you got to figure out where you are so that you can map out a course to get there. Now, a planner is going to say, here's where you want to go, here's where you are, and here's the course to get there. Have a nice day. A coach is going to say, here's where you want to go, here's where you are. I'll help you with turn by turn directions.
Mhm.
Right? So that's to me the differentiator between a coach and an educator. An educator is just going to tell you, like, for example, you might say, Paris, what's the best way to get out of debt? Well, I'll show you the 6 strategies and the 7 different things. And then I can educate you and then say, good luck, go do it. Or I can say, I'll give you the education and then let's actually figure out which one's going to work best for you. And then let's meet once a month or as often as you like and make sure you're on track.
That makes all the sense. Enough preamble, right? Let's delve right into our conversation. And I think that preamble was very necessary to kind of paint a background. And so now that we have that over with, I want to approach this conversation from a lens of, you know, breaking money conversations down into income conversations and then expense conversations, right?
Hmm.
We're going to talk about, how should people think about increasing income? What should they focus on and things like that. And then we're going to talk in terms of expense about budgeting and things like that. But I want to start from the expense part, right? Budgeting is a very interesting conversation because it's something a lot of people tend to run away from. A lot of people see budgeting as, the document that tells you all the money you don't have and reminds you about all the things you cannot do. They interpret it in that very restrictive sense. How do
Yeah.
you interpret budget and how do you convince people that this is something that they should invest time in knowing how to do?
Yeah, I actually really appreciate that most of your audiences are business owners because they're really going to relate to what I'm about to say. So when I sit down with somebody, the first thing I want to do is what's called a cash flow statement. And in business, your CFO or your financial, whoever you use as your financial person, if it's yourself or if it's an actual CFO, they're going to look at your financials. They're going to look at your income and your expenses. That's a cash flow statement. How much is coming in, how much is going out? You want to track all of those things. Now, I personally, there's a funny thing in finance that budgeting is like the B word, that's a bad word. Don't say the budgeting word. But I think, budgeting is telling your money where you want it to go, not telling you what to do with it. So at the end of the month, if you can having control of your money and having a cash flow tracking system, that's what I call it a cash flow tracking system. And I keep track of my money every month. I work in averages because I'm self-employed. Some months I'll make a lot of money and some months I don't make as much. And so I kind of average things out and I have strategies for how to make sure I manage that over time. But if you track the cash flow that's coming in and then you track the cash flow that's going out and you do that by averages, and now I have a 12-month. I've been doing it for so long. I have a 12-month running average. And so as long as I'm within kind of that average, I don't worry about every little dollar where it goes, if that makes sense. And so when I do budgeting, it's more of, hey, am I within my average? Am I on track? Am I doing okay? And is it less than obviously the first thing you want to do is to learn to live within your means. So basically you want to be spending less than you're making and then grow your means. So I really like that you said that you want to talk about income and expenses because how you treat $1,000 is how you'll treat 10,000. So
Yeah.
if you don't know how to manage 1,000, if I all of a sudden start giving you $10,000 a month, you're just going to have the same problem at a bigger level. So it's important to learn how to track your money and manage it correctly.
Yeah, yeah, kind of to what you already said, right? I want you to now talk a bit more about some of the budgeting mistakes you see people make in your line of work online. What are the most common budgeting mistakes you see?
Well, I actually have a YouTube channel, and I did a YouTube video recently about what I call the holes in your bank account. And these are simple things that nickel and dime us to death. Let me tell you a personal story how I learned this. So many years ago, I lost my wedding ring, and of course that's not a good thing. And so
Yeah.
I wanted to buy a new one, and I found one that I really liked, and it was $600. And I was like, okay, babe, I told my wife I need to make X number of sales and X number of commission in order to pay the bills. And then I need to make an X number of additional calls, additional sales, and additional commissions in order to be able to buy the ring. And so I had a goal and I had a sales goal and I created a plan and I hit the plan. I nailed the plan and hit the goal and the commissions came in and I sat down to pay all my bills and then I was going to take the extra money and go buy the wedding ring. Well, when I got to the end of this, and how many of your listeners have done this too, right? You pay all the bills and you're like, wait a minute, where did all the money go? I know I made good money. I
Yeah.
know that it came in. I know the commissions came in. Where did the
Mm,
money go?
yeah.
I didn't have it. The money was gone. There was no money left for the wedding ring. And so I turned to my wife and I said, hey, did anything come up? Did any unexpected expenses happen? And she says, not that I know of. I mean, I bought a few things here and there for 10 or $20. I was like, huh, let me go check those here and there 10 or $20. And the here, it all added up to about $900 that month of here and there, 10 or $20. I think that's the number one problem is that there's holes in your bank account and the holes are draining you. That you're filling up your bank account with the water. Think of it like a colander or a sink. You know, if you want to fill up a bowl, you don't use a colander. You use an actual bowl and you get rid of the holes and the cracks.
Yeah.
There's an old saying, a ship with any hole will sink. And so that's the same thing. No matter what you're doing, you gotta be careful with those and that kind of contradicts a little bit about my tracking system that I shared with earlier about every little detail. But you have to know where all your money is going. And most
Yeah.
millionaires do. Actually, if you statistically surveyed millionaires, they know almost to the dollar where all their money's going every month. That's why they're millionaires because they know they control their expenses. So that's the number one budgeting tip that I learned and that's what I share with my clients is we need to patch the holes as soon as possible.
Yeah. That's really profound. And I like that you started talking in that direction because personally, one of the things I've noticed is a lot of people they don't want to appear like they're super finicky about money. So they don't want to track every dollar. But in my head, I'm like, I know everybody who actually has money, every millionaire. You don't even have to be a millionaire, but everyone who makes decent money and know where their money goes, they tend to have better financial outcomes, right? So that
Yeah.
you can track your expenses, know what you are paying for. Another mistake that a lot of people make is they have so many subscriptions. I
Mm,
realized recently that a lot of people are paying for subscription that they stopped using years ago, like
yes.
literally. See, I consider myself to be super on top of my finances, and yet I still realized recently that the subscription I was using when I was in England, that was 3 years ago, that I mean, I don't live in England anymore. I haven't lived there for 3 years, and I kept paying that subscription every month for 3 years. That's 36 months of paying what 7.99. That's money
Wow.
that could have gone into some sort of stock, right? So that's
Yeah.
another thing. A lot of people just don't track subscriptions. Oh, it's 11.99 there, it's 9.99 there, and these things add up. And like you said, in your finances, kind of, digging down a bit more on that thread that we started pulling, right? Aside budget mistakes, what else do you see that people get wrong? Or let me say, what should an ideal budget look like? What are the essential components of an effective budget?
To start, I think that mindset, to me, money has more to do with your mindsets, your habits, behaviors, and beliefs than it does with math.
Okay.
And if you aren't intentional with your money, you're going to give it to someone who is. And so I really believe that you need to be more intentional with your money. That's another part of it too, is that you might say, well, it's only 7.99. Well, 7.99 over time like you said, like how much could that compound into if you were investing it properly? Or let's just even if you know, 8 or 9, 10% interest rate is not in terms of earning money isn't going to be attractive to you. Imagine 799 over time paying off your credit card debt at 24%. Like that's a way better deal.
Yeah.
I think a lot of people just the components of your budget should be there's 2 a budget boils down to 2 major areas. One is fixed expenses and the other one is variable expenses. Now, fixed expenses are those expenses that don't change every month. It's your car payment, it's your house rent or mortgage, it's your
Yeah.
everything that stays the same. It's the same every month. Then there's the variable expenses, and fixed expenses do need to be adjusted from time to time. However, it's the variable expenses that really get us because we're like, oh, you know what? I'm just going to go out to dinner. And you're like, oh, it was only $100 for my wife and I and my kid, whatever, to go out to dinner that, or 200, whatever it was. And, you realize that if you do that every week, that's 400 or $500 a month now. And so I was just, you know, there's this really amazing Mexican hole in the wall place that's like, it's really affordable, frankly. And so when my family goes, it's like, it's delicious food and it's a ton and it's like 60 or 70, you know, it's like 50 or $60. Like, and then we add the tip, of course. But what's crazy is that I realized if I did that every week, that's like $300 a month.
Yeah.
You know what I mean? So just being aware of those variable expenses. You know, what is your cell phone bill? Have you so
Mm.
what I like to do every so often, every quarter, every 6 months, is I like to look at my fixed expenses and say, is there anything I can do to reduce this or adjust it or make it more affordable or you know make it work for my budget more. Then I'll
Yeah.
look at my variable expenses and sometimes I'll pick you know, a bunch of them, and sometimes I'll just pick one. And my wife and I, at the beginning of the year, one of our goals was to kind of get a little bit more dialed in on our finances. And so we started looking at all of our Amazon subscribe and save. And we realized that there were some things on there that we didn't need anymore. We weren't
Mm.
using, and it really wasn't giving us the result we thought it was, but it was still coming every month. And we were still taking it every month for some reason. We're like, you know what? Why are we still buying this? There's going to be things like that on your Apple. If you right now, I don't know how where you're listening to this phone, but pull out your phone, look at your Apple subscriptions, and figure out are there stuff there that you're paying for you don't even use anymore? I mean, let's be honest with yourself. If you haven't gone to the gym in 6 months, you're probably not gonna go next month. You know
Yeah.
what I mean? It's cheaper often to pay as you go than to make that monthly payment, because you're not gonna go as often. If you know, it might be $10 every time you go, and it's $30 a month to be a member, but you only
Yeah.
go once a week. Well, it's
Mm.
actually or, you know, a couple times a month. It's actually cheaper to just pay as you go. So I think you know, with those variable fixed expenses are harder to adjust. I actually, many years ago, I lost everything, and so my house, my car. I mean, I have a country music song I could write about my experience. I lost everything, and it was because I had also had more fixed expenses than I probably should have. It was the 2008, the economic downturn of 2008.
Mm. Mm.
Lots of people were really affected. My business was one of those. And so I just really feel like fixed expenses and variable expenses are the 2 main things. And then within variable expenses, there's some that you really that's variable is more discretionary. You have a choice whether or not you should do it. You know, how much do you drive? How much do you go out to eat? How much groceries do you get? How much gas do you purchase? How many cell phones do you have on your plan? Like there's a lot of different things in variable that you can do. You can adjust that more readily.
Yeah. Yeah. No, thanks for sharing. That's very profound. Now I'm gonna play the devil's advocate
Hmm.
and tell you one of the things I hear people say a lot, and it's about the fact that I mean budgeting is nice, being on top of your expenses is nice, but essentially you can do whatever you want with your expenses. If you don't increase your revenue or your income, you're still not gonna build wealth, right? No, I don't know if you're making 50K a year, say $50,000 a year and you realize, oh, I'm spending $30,000, you can decide to say, well, I'm going to try and cut my expenses to 20K so that I can be saving 30K. Or you can say, well, I'm going to try and increase my income to 80K. And now, even though you're still spending 30K, you're saving 50K, right? So
Hmm.
it's essentially this idea of, budgeting is nice, but should I instead focus on increasing my revenue? What do you say to that?
Oh, I agree 100%. I think that you should manage your money first. Learn to manage your money. Get disciplined. Again, I shared earlier at this beginning of this, everybody wants financial freedom. Financial freedom is on the other side of financial discipline. So how you treat a $50,000 income is how you're going to treat a $100,000 income. So if you're making 50 and spending 50 and you start making 100 and you haven't changed your habits, behaviors, and beliefs, soon you're going to start spending 100. And then you really didn't do anything any good for yourself. So once you learn to discipline your spending and you have a strategy, when money comes in, you have a strategy for it. This percentage goes to fixed. This percentage goes to variable. This percentage goes to savings. I have what's called a cash flow process. So in the average American, when their cash flow goes something like this, they earn, they spend, they borrow, and then spend more. A wealthy person or somebody who wants to turn their income into wealth, what they'll do is they'll earn, they'll save a little bit, they'll spend the difference, and then they'll invest what's left over. So once you build some save, and there's some nuance to that. That's kind of a macro level of it, but if you realize that the first bill you should pay is your retirement, is your savings account, is your sinking fund,
Investment,
your
yeah,
emergency fund,
yeah.
then you need to, if I, for personally, there's a ladder. It's earn your income. The next thing is have an emergency fund. The next thing is pay off debt. The next thing is make sure that your risk management is squared away. Like you have the right kinds of, all the different kinds of insurance that you need, and then start building some wealth, and then leaving a legacy for your family can really make it happen. But if you're not paying attention, your money is going to get away from you, whether you're making 50, 75 or 100,000. And that's one of the things that is so easy. Like I upgraded to this home that I'm living in now about 4 years ago. I was making a lot more money. So I was following your very strategy, IO. And so I was made more money. I was managing my money that I had well. And there's something
Yeah,
about, and this might sound a little hokey or a little bit weird, but money likes to be respected. So if you
yes,
respect money, money will respect you.
I
They
agree.
say a fool and his money are soon parted. And then
Mm,
they ask, well, how did the fool and the money get together in the first place, right?
mm,
Well, don't if you're wise with your money, the money's going to be like, hey, I like this guy. I want to stick
mm.
around.
I want to stay here. Yeah,
Yeah, I want to stay here. So I was managing my money properly, and then I moved to another state, and I upgraded. My house is 50% bigger. I had all these things, and when I went to the loan officer, they said, "Hey, Paris, with your income, you qualify for this much house." And I was like, "Oh wow, that's great, but what's the monthly payment?" And he told me, and I was like, I didn't want to pay that. Like that wasn't my frugal value based lifestyle. I didn't want to pay that. So I said, this is what I want to pay. What kind of houses am I looking
what
at with what I
can
want
I
to
get?
pay?
Yeah,
Yeah. And so he said, okay, this is the range of house you're looking for. And I'm like, great. So I live in a beautiful house. I actually could have afforded, according to my qualifications, I could afford to double the house that I have. But I wanted to be wise with my money, and I bought the house that I was in charge of. And that's the discipline. Most millionaires today actually buy Toyotas and Hondas, and they buy a couple years old, even some of
yeah,
them.
yeah,
They don't buy Ferraris and Bugattis and all these other things. So it's the discipline. When you're on rich, it's the difference between rich and wealthy. In my opinion, rich is flashy and loud. Wealthy is quiet and just solid. And I want to be wealthy. I want that by my definition, I want to be wealthy, and I want to really build something. And it really is in your mind. It's your mindset, your habits and behaviors. So if you're making right now 60% statistically, if you Google this right now, 60% roughly of people who earn six figures still feel like they're living paycheck to paycheck. So is it about how much you earn? Certainly. But is it more about how well you manage it, how well you keep it, how well you strategize it? I think that there's a lack right now of everybody. If you go on TikTok or Instagram or even YouTube, everybody will tell you how to make more money.
yeah,
I just don't feel like there's a balance because it's the same coin. Make money on one side, manage money on the other. It's the same coin. And so what are you doing to manage the money you're making? Learn to live within your means and then grow your means.
yeah.
If you manage money, it respects you. It'll tell its friends to come.
That's profound. That's profound. You spoke earlier about spending ladders. I don't know if that's what you called it, but you know how people say you make X amount of money. I think the most popular one is the 50, 20, 30. I
Yeah,
think
50,
you
30,
spend
20.
50%.
Yeah.
Yeah, that's the one. Yeah. You spend 50%, you save 30%, I think, and then 20% goes to investment or something like that. Well, what do you think of that? What does your ideal spending ladder look
I think that's a great ladder. It's actually 50% to fixed costs, 30% to variable costs, and 20% to savings and investments.
like?
And I think that's a great strategy if you can do it. And some people right now, they're like, Paris, I can't save 20% of my income. Well, can you save a dollar?
Hmm.
Yeah, but what's a dollar going to do? Trust me, it's the habit, not the amount. Start saving a dollar a month. Pretty soon, you're going to see that dollar turn to $2 a month and $10 a month and $20 a month. And before you know it, you're going to have a savings account that's got several hundred or a couple thousand in there. And you're like, wow, this actually worked. And so 50, 30, 20 is a good strategy if you can do it. If you're not disciplined enough for that, just really get clear on your fixed costs, get clear on your variable costs. And I shared with you before we started the show that I have a budget, an ebook that I offer, and it really goes into this actually pretty well. And so when I first started as a financial advisor, I had stocks, mutual funds. I had a lot of stuff I wanted to offer people to be able to help them, invest for their future. And so I would call the people on the phone and say, hey, look, I want to help you invest in your future. And they're like, Paris, I'm in debt. My budget is so tight. I hardly have any money left over at the end of the month. I have more month at the end of my money than I do money at the end of my month. So
Yeah.
and I said, you know what? If I'm really going to be successful in this business, I need to help people find money that they're already spending, basically help them, patch the holes. And it's turned into now patching the holes in your bank account. But how do I help people find more money? And really, it's figuring out what you can do and disciplining your expenses, whether it's 50, 30, 20, or it's 50, 40, 10, or it's 50, 45, 5 right now, or it's 60, 30, 5 and then 5 because all you can save right now is 5. Whatever it is, figure out what your fixed expenses are, figure out what your variable expenses are. This is how you start. You might end up at 50, 30, 20, but how do you start? Well, you got to figure out what are all my fixed expenses, your house payment, your car payment, the things that don't change. What are my variable expenses? That's everything else. And then how much money am I saving every month? Add that in. And even your 401k, if you're still an employee of some kind and you're doing a side hustle, do that. If you're a business owner and you offer 401ks, you're probably participating yourself. If you're a business owner and you don't have a retirement plan, then that's something to talk about. But you can figure out what are your percentages to start. And then once you know what they are, you can make adjustments. You can start to work on getting it towards your goal of 50, 30, 20, or whatever it ends up being, whatever your goal ends up being. But if you don't know where you are, there's an old saying, if you don't care where you are, you're not lost.
Hmm.
And so there's a lot more people that are lost than they realize
And they
because
know.
they don't care as much as they should.
This is very profound. I like all the things that you're saying, Paris. Let's pull again on one thread that you pulled out very, very briefly, which is the idea. I see a lot of people, and I don't agree, but what I see a lot of people do is essentially they say, oh, what do I need to survive in the month? Figure out all the expenses, which is, as you said, it makes sense to budget. And then at the end, they're like, oh, I have $200 left. I'm going to save that or invest that, right? I think that you should always start by even first. I think you should decide, I make $100, I'm gonna save $30. Now you might end up having to go back and take $2 out of the $30 or $5 out of the $30. I find that every time I save first, I end up saving more because
Mm.
once I've taken away my savings, the pot becomes smaller. So I kind of organize my expenses around a smaller pot rather than if I say, oh, I have this big pot, and then I want to say, oh, what are all the expenses I have? I tend to prioritize things that aren't that, important, things I can actually survive without, and I end up saving less. What do you think about that?
I love that. I think
And
you're
what
right
would
on
be your
track.
preferred strategy? Yeah,
I think that there's an abundance. And again, this might sound a little woo woo or hokey, but there's an abundance mentality that when you treat money correctly and you treat it with respect, it will respect you back. I know again, it sounds a little wild. And some
I
of you are
agree.
probably thinking, this guy's crazy. What did Iogi do? Where did he find this guy? Right.
Where do you find this guy?
So what I do is this is what I do. This is my strategy. So you say you save first and then you have your expenses. So I do the same thing, but I do it strategically. And strategically is just a fancy word for saying that I have an organized way of doing it. So I'm not sure if you've ever heard of something called sinking funds.
Yeah.
Many years ago, there was a government, I think it was in the Netherlands. They came up with this term of sinking funds, where they said, you know what, we need to fix the roads, we need to fix the
Mm,
the buildings, we need to fix the
mm.
office, so they put aside money for that. They put aside money
Perfect.
for the everything. Like I have years ago, I was like, you know what, we spend several $1,000s every year for Christmas, and for some reason, Christmas always. I mean, for those that celebrate it, I'm sure not everybody does, but for those that celebrate it, we know it's coming. Like it comes every year, right?
Come, right? Yeah.
Right? And the other thing is, how many of you own a car who are listening to this? Like, you should have a car repair fund. How many of you own a home? You should have a home repair fund. So I actually have a Christmas fund. I start putting into it every January. January. So when December hits, I already have the money. I can already, and I don't have to worry about, oh my gosh, did I overspend? I literally say, I tell my wife and all the family, this is how much money we have because we've saved since January, and this is how much we can spend on Christmas. We used to have a birthday fund, but then we never really stuck to it, so I decided to forget that. But I save, and I have a Christmas fund, I have a car insurance fund, I have a car repair fund, I have a home repair fund, I have a wedding fund for because I have kids that I told them I'd give them a certain number of dollars for a wedding. I have a vacations fund for vacations I want to take and just trips that I want to do.
Mm,
So I have a personal savings fund for stuff that I think about and I want to buy. The reason why I do that, IO, is because I believe that there's another pandemic in the world, and that's
mm.
the pandemic of spending tomorrow's money today.
Today.
Debt is it's they call it the buy now, pay later. I
Mm.
think that is a sinister plot to destroy the world. That's like, I don't know, that to me is like there's got to be somebody up there in some chair in the middle of the said, let's figure out how we can destroy the average American person.
Mm.
Let's get him to spend his money tomorrow's money today. Anyways, I believe in spending pardon me, I believe in spending yesterday's money today. And so I save first. And it was funny too, because my wife and I were just talking about some house things we wanted to do, some upgrades. And she looks at me and she says, this whole saving first thing before we buy stuff isn't as fun as sometimes as it should be. Why can't we just go into debt for it? I'm like, well, because we'd committed to never going to debt. I haven't, I lost, when I lost everything in 2008, I've not ever had consumer debt since. I have a mortgage. My wife went to school and she went to a trade school. And so we have a school loan we're paying for. But other than that, I've not paid any interest unless there was a mistake of some kind throughout the years. I've not paid consumer debt for 15 years. And it's because I switched. I save first. And then if I want to buy something, I pull from my savings, a savings account that was specifically designed for that purpose. Yep. And that's how I do it.
Well, this is good strategy, and you seem to always touch on the things that I want to talk about next, and I love that. I really am enjoying this conversation. But before
Thank
I
you.
talk about what I want us to talk about next, I just wanted to chip in that I'm not sure if this exists in the US, but when I was in England, for example, there's this fintech firm called Monzo, and one of the services that they offered was that you could create kind of an investment fund, but you didn't have to put any money in it. Instead, what they were going to do is every time you make an expense or you make a payment, say you pay for something it's $10 and I mean pounds, say it's £10 and I don't know, 50 pence, for example. They will
Mm-hmm.
take the remaining, so they'll round it up to 11. They always round it up. They round it up to
Mm-hmm.
11 pence, to 11 pounds, and take that zero point 0.5 pound or 50 pence and put it in that investment fund for you. So you pay for something and it's $50 and 2 cents, for example. They round
Mm-hmm.
it up to $51 and keep 98 cents for you in the investment fund. You know, you wouldn't notice it, but eventually, if you look at it after like a month or two, you might see $110 there or
Yeah.
£110. And that is the money you would then use to invest. That was a very good strategy that a lot of my friends and, people that I used to speak to, I kind of got them into doing that. And a lot of them now just have like one or two investment accounts that they essentially funded for free, if you know what I mean. And I
Yeah.
don't know if that exists. I'll try and do some research and put a link to some of that in the description. But I wanted to just share that before I forgot.
No, there is something like that. It's called
Okay,
Acorns. Acorns. I don't have an account. I used to have an
perfect.
account doing it, but I'm more disciplined with my investment strategy, so
Yeah,
I manage it myself.
yeah.
But Acorns allows for that. I'm sure there's others that do it, but I know Acorns does that too. Acorns.com, I think is.
Perfect. And that was the caveat I was gonna put in, right? That works for people who say you're just trying to learn financial discipline. That's a good place to start.
Hmm.
I mean, it's better to take a more intentional approach to your finances and manage it yourself. But if you can
Yeah.
do that, that's a good place to start. Now, back to what you pulled, the string you pulled that I wanted us to keep pulling. Spoke about sinking fund, right? And that got me thinking about financial planning. And I heard a lot of people talk about essentially how to plan your finance. So say you just graduated college and you're trying to figure out what your financial plan should be. You're trying to set up yourself for success. I've heard people say your first 2 or 3 months of working, you should be trying to save double or three times your income into a sinking or emergency fund that if you lose your job today, you can still afford to pay your expenses for 3 months. And then after that, say try to raise 1.5 times or two times your annual income for investment in stocks and things like that. You know where I'm going with this. What do you think in terms of financial planning? How should people approach it, especially if they are just like getting into this financial discipline? Conversation?
So part of the reason why, again, because I shared with you that money has more to do with habits, behaviors, and beliefs, especially financial planning. I mean, we all know that if we have $100 and we spend 110, we did the wrong thing. We all know
Yeah,
that. Like the math is, it's easy
it's
subtraction,
yeah,
but we still do it. Why do we do it? There's a behavior inside of us that says, "What does I want to do?" So, what I say is, so when people look at emergency funds, they're like, okay, let's pretend that somebody makes $5,000. Their expenses are $5,000 a month. And they're like, okay, I got to save 3 to 6 months of expenses. That's 15 to 30 grand. They're like,
mm,
I could barely pay for the groceries this month, let alone set
mm,
aside 30 grand. How
yeah,
do I do that? And so I say, okay, let's break it down. You know, the old adage, you can eat an elephant one bite at a time, right? The journey of 1,000 miles begins with one step at a time. So that's part of what a coach will do. A planner will say, here's what you got to do, go do it. And a advisor will say, well, these are the things you need to buy in order to make it work. And a coach will say, okay, this is the goal, but let's start today. What do we need to do today? What do we need to do tomorrow? What do we do first, second, third? And let's get this thing squared away for you. So I say, let's get 1 month's fixed expenses first. Now, for me, 1 month fixed expenses is going to be so you don't lose your mortgage. You don't lose your car. You have 1 month. Get a fixed expenses for 1 month. Put it in a savings account in the bank, a brick and
okay,
mortar bank. Then build month two. Month two should go into a high yield savings account somewhere in the neighborhood of 4 or 5%. There's plenty of them out there, by the way. Ally Bank is one. Ally Bank does the sinking funds too, where you can do sub accounts. Fantastic. There's several of them out there. Capital One has a good one. Chase has a good one. American Express has good ones. Anyways, they're all high yield savings accounts.
yeah,
Month two and three should be fixed expenses first, month two and three. Then go back to month one and start adding in all your variable expenses so that you can go buy groceries if you need to. I have a little bit of a different approach. I have a lot of ancestors that are pioneers and they have a lot of that, so I believe in food storage. And so I have a pantry upstairs where it's my readily accessible pantry. And then I have a second pantry downstairs. I have almost 3 months worth of food in my downstairs pantry. So if I run out of anything upstairs, I can literally go downstairs and get it. In fact, I still go to the store every week and I buy things to replenish. I went to the store and that lady asked me one time, she says, I only see you in here once a week. Why is that? And I said, well, I could probably go every other week, but milk and fruit and stuff I buy every week. But
yeah, exactly.
she says, why are you only in here once a week? And I said, because I buy enough. I have 2 or 3 of everything in my downstairs pantry so I can fund it. So if I lost my job, what are the things I'm going to need to do? I'm going to need to pay my mortgage.
Yeah,
I'm going to need to pay for my car, cell phone probably to find a new job, and I'm going to need to eat. So if I have money in cash to go eat, or if I have food in storage to eat, either way, I get to eat. So I tell people have a little bit of food storage. But once you have your variable expenses for month one, then move to month two and three. 3 months is a minimum for your
mm,
expenses. Now, if you have a really secure job, frankly, I don't know that the word secure and job should go in the same sentence, but I'm an entrepreneur and I kind of have that little, sassy in me. But if you're an entrepreneur and you're commission only and you don't have a significant passive income that's regular, you probably should be 6 months to 12 months of a savings of an emergency because you might go through a cycle of
yeah,
a downturn in your business for 3 or 4 months,
yeah,
especially if you have a payroll. You're going to
Yeah.
want to have business emergency fund separate from your personal emergency fund so that you can meet payroll. And so those are some things that I would say first is emergency fund. Like there's another guru out there that says just get $1,000, and I'm like, I don't know how much $1,000. I don't know how far $1,000 will go anymore, but
Right.
I'm just like 1 month's fixed expenses,
Mm,
and then
mm,
second month fixed expenses, then third month, and put the first month into your bank account that you can easily transfer in and out, and then the second and third and fourth and fifth months go high yield savings account, earn 4, 5, 6% on some of those. It's not an investment account; it's a high yield savings account, still with FDIC, and 4% is
mm.
really running the mill right now.
Yeah. Yeah.
As of this recording, you may be listening to this in a year or two, and it may not be 4% anymore, but right now it's 4%.
Yeah. Yeah. The date is 17th July 2025, just in case you're watching 5 years time. But I like where this conversation is going, and I feel like we could keep pulling on so many different strings. We're gonna run out of time soon, but I want us to talk about investment, right? And how people should handle it. Because I've seen people do all the right things, budget properly, try to forecast or just forecast their income, project their income, and spend according to what they're actually expecting. And still, one does a downturn in their income, they lose their job, and 2 months later, out on the streets, right? Essentially, people struggle to build resilient lifestyle. And I feel like sometimes it's because people do the wrong things, but other times it's actually doing the right things that can put you in trouble. For example, right, you could do the right things to save and invest, but put all your money in the stock market, you lose your job, the stock market also crashes, and so all your savings and investment goes to zero. It's as though you never invested, right? So let's talk a bit more about how people should think about investment and what the right kinds of investments are based on, percentages of people's wealth and where they are in their own financial planning journey.
Yeah. Most Americans, and this is a statistic out of America, I'm most familiar with America. Most Americans have 90% of Americans have a positive net worth if you include the equity in their home. If you take the equity out of your home, which I think you should do because it's kind of cheating, if you
Yeah,
take the equity out of your home, only 30% of Americans have a positive net worth. That's a huge gap. And so what I teach after I teach people to develop a cash flow statement, I then teach them to create what's called a balance sheet. A balance sheet is all of your assets and all of your liabilities. What's most important is that you're growing your net worth, that your net worth is going positive in a positive direction every single month. Now,
yeah,
that might be you're paying off debt. It might be you're building some more savings accounts. It may be that you're actually investing in the stock market. In 2008, I had almost all of I had a nice little 2 or 3 month saving. I had probably 3 or so months of money, and I drained it quick. And then I went to my investments and drained that quick. And 6 months after 2008, 6 months, I had to move in with my brother. And we combined our both of our incomes, and my wife went back to work and his wife went to work. Like and we were in business together. We lost everything. And so we did what we had to make it right. And so I got smart after that. And I said, you know what? I need a bigger buffer zone. I want a wider buffer zone. I'm more conservative than I ever was. I'm more intentional with my money than I was before. And so my personal opinion is you can invest at the same time as you're saving,
yeah,
but don't stop saving money. Don't
yeah,
stop building that strong buffer zone.
yeah,
Here's an example. I had a guy that I talked to the other day, and he's like, Paris, I was trading stocks. I was day trading and swing trading. He says, I borrowed some money from my buddy. I took all the money that I had, and I made a ton of money. I made like tens of thousands of dollars. And then I lost it all. And I said, oh, did you take any of it and save it? Did you create what I call a risk management program strategy? Because life is risky. If Mother Nature doesn't kill you, disease and other things are going to kill you,
yeah,
right?
yeah,
With all the flooding and all the natural disasters that we see in the world, right?
yeah,
It's risky to be alive. And so let's mitigate some of those risks. Do we have health insurance? Do we have health insurance? We have car insurance. We have life insurance, but do we have investment insurance? To me, investment insurance is your savings account. It's your emergency fund. So if you do lose all your investment, the stock market drops. And that's another thing too, is that in my opinion, you should have a very strong buffer of savings. Then have a very boring portfolio. have a very
That's really good.
boring portfolio, like S&P 500 boring. Like put it, and then you're like, and here's the thing. I'm not sure if you, for your listeners, have ever heard of something called the financial independence number. It's really been made popular recently by the FIRE movement, FIRE, financial independence, retire early. And they basically assert that retirement isn't an age, it's a dollar amount. So once you have enough money saved up that you could live off the interest and the interest will pay your bills, you no longer have to work and you become work optional. And now you can live in a semi retirement or you build some kind of passive income that does it. So what is your financial independence number? If your expenses are $50,000 a year, your financial independence number is about 1.2, 1.3 million. So as soon as you get to 1.3 million, you're done. Or as soon as you have enough contribution to your investment that you know that invariably you'll get there because you're contributing 400 or $500 a month, whatever it is. Look, if in the next 20 years, if I contribute this much money at this interest rate, I'll hit my goal. Okay,
Mm,
now you know. And then you get a raise. I actually have a client right now. They just got a raise, and it's like significant, several $100s a month. He's like, "What
yeah,
should I do with that?" Well, either we accelerate the boring and get you to retirement faster,
yeah,
or now we can take a couple $100 and we can go start a business, or we can
yeah,
buy some real estate, or we can
yeah,
diversify.
yeah,
You can start day trading if you wanted to, because that extra
yeah,
money now is, we can, there's, do you see what I'm saying? Is you want to build a strong foundation of boring.
yeah.
And then when you actually have extra money, then you can go speculative on
Yeah,
that.
yeah, yeah. So this is such good advice. And the only thing I'm going to add to that is, and this is something I learned in business school, right? Is the entire idea that when you invest, be very careful not to invest in stocks or generally any investment that is directly correlated or very correlated with your source of income.
Mm-hmm.
It should be a no-no for you. And correlation is a fancy word that just means, the degree to which two things move in the same direction, right? So
Mm-hmm.
temperature and I mean the weather being cold and rain falling is they're probably quite correlated, right? Because if there's a high chance that if the temperature drops to say minus something, it's gonna rain, or if it rains, the temperature is gonna drop. So that's a bit of correlation, right? The idea is if you work, say, in tech, say you work for Amazon, you probably shouldn't have any Amazon stock in your portfolio. The reason is because Amazon stock might be very good, but if something happens and Amazon experiences a bad time, you probably get laid off at work and your stock is also going to tank. That's double jeopardy. And that's one of two, something you said, right? You want to have boring stock. So S&P 500 is fine, but I even think S&P 500 is fancy. I would do something like commodities, a commodity mutual fund, like, assets or institutions that are going to remain irrespective of what happens in the world. So think about utilities, energy. People need
Mm-hmm.
to power their homes, whether or not there's a financial downturn. People have need for power, for energy, for water. Having a collection of stocks in very boring fields like energy, utilities, water,
Mm-hmm.
all of that, you should have a decent amount of that, especially if you work in a very volatile industry like technology and banking and consulting, industries that are very, very correlated with the overall economy. So thank you so much for mentioning that. I have just one final question for you, so I can let you go. A lot of people don't have financial planners or financial coaches, and the excuse is, oh, they're really expensive. When I start making six figures or when I start making a quarter of $1 million, I can afford that. What do you see? How expensive are financial coaches and financial planners, and when is the right time to get one?
So I totally get it, because what's funny about being a financial coach is I'm kind of conflicted because I know your budget, I know what you can afford, and I know what I charge.
Yeah,
It's kind of like,
yeah,
how can I justify charging that for what it is? And it really boils down to the results. If you've been going along for years and if you always do what you've always done, you'll always get what you've always got. If you don't like what you're getting, change what you're doing. Here's an example. I have a client right now that they're like, Paris, we get out of debt and then we get right back into debt. And then we get out of debt, we get back into debt. Like, what are some things we can do to get out of debt and stay out of debt? I've been working with them for about 3 or 4 months now, and they pay me a monthly fee to work with them. And I have given them, probably just from the strategies that I've shared with them that they didn't know before I met with them, they were able to increase their net worth by almost $20,000 just in the last 4 months. Some of that has to do with again, I can't take credit for all of that. Some of that has to do with the great growth in the stock market, but for sure, they were able to pay off almost $9,000 in debt just from one strategy, not changing very much in their budget, but just from using a strategy that's very little known or that's kind of hyped out there that people are kind of scared to because it's like, what is this? But I walked them through it and because I know how to do it. And they said, let's go. And they $6,000 in debt in 3 months paid off without changing much of your budget.
Yeah.
I my ebook alone, I've had people save 300 to $800 a month, not just once, but every single month because they figured out how to patch the holes in their budget. They figured out how to patch the holes in their bank account.
Yeah. Yeah.
If you invest in a coach and they don't give you at least a 5 to 10x return, it's time to change coaches. My goal is to help you um, really increase. I have a lot of free stuff. I have a lot of group stuff that's the very low hanging fruit, and then I have one-on-one. I have programs. You need to find a coach that is going to fit your personality because you want to have somebody that's kind of like you that can kind of coach you through. Because really, coaches are life coaches with a focus on money. But I
Mhm.
promise you that if you do, here's what I'm saying: if you're sick and tired of what you've been getting, it's time to change, and that change might be hiring a coach that will get you what you need to do and get you where you need to be.
Yeah. Yeah. And when is the right time to get a coach?
Probably 20 years ago, but the next best time is today.
Perfect. Wanted to make sure we got that out. And how can people find you if they want to connect?
Well, once again, my name is Paris Cluff, Parisclu, F like Frank. You can find me anywhere on socials. If you go to my website, is it okay, Io, if I
Yes,
offer my
please.
free ebook?
Yes,
So if you
please.
go to my website, which is pariscluff.com, and then you hit /free book. So pariscluff.com /free book, you'll be able to download my ebook. And this is the strategy that I used years ago when I was an advisor to help people find money in their current cash flow and just help them find hundreds of dollars a month that they could. I was in a very poor part of town and this lady was like, we don't have two nickels to rub together.
Mm.
After a few strategies, we were at $800 a month that she could invest to her future. And we took a few hundred of it and we started doing some things. So there's things you don't know that other people know that can help you.
Yep.
So free book, and there's some people learn with video and audio. So there's an upgrade. The book is free, the ebook is free, it's actionable, but there's an upgrade if you want to that you can learn from a video course. And there's more workbooks. It kind of expands on the ebook if you want to do the upgrade.
Mm.
Then that's just once you do that, I'll probably be reaching out soon with emails and other things. And there's more ways to help after that.
Perfect. Perfect. And I'm gonna put a link to this ebook in the description as well. But yes, this was a very actionable, very um, tangible conversation. You're the first person I'm saying this to, but I probably will invite you back at some other point. I feel like there's so many other places, so many other strings we could pull. There's so much value in this conversation. And I just want to thank you for coming on the show.
Thank you. It was a pleasure.
Thank you. And listeners, see you guys in another episode of the Business 101 podcast.